The story of mainland China over the past few years has been one of slowing growth and increasing tightening regulatory environments. Even before the onset of COVID, there were red flags of possible signs of a slowdown. Still, a string of unexpected regulatory moves from policymakers has also contributed to the more challenging business environment and possibly impacted overall market optimism. Companies rapidly adapted to a new regulatory climate. From technology, finance, education, and transport sectors, it impacted everyone across the board. These obstacles also bled into M&A, which has also seen a slump in outbound deals and potentially a flurry of reactive deal-making in the domestic markets. But perhaps the most important policy drivers over the past few years have been around ESG. The financial industry and the corporations that serve them are under increasing pressure to incorporate ESG principles into their business practices and to help pursue the lofty goals of carbon neutrality. But a lack of maturity in the ESG space means that the strategy is often, underdeveloped, and reliable information tends to be hard to come by. And this is what brings us here today. Hello, and welcome to today's discussion, regulation, ESG, and investment, the China story. My name is Bradley Maclean, and I'm a co-founder of Regulation Asia. Now, some of our listeners may have already been aware and have read our first two parts of our recent research report were published over the past few days. As an FYI, part 3, the final chapter, will be published after today's webinar. But the research was based on a series of interviews with domestic institutions, in fact, 90 institutions overall, covering retail, corporate, investment banking, asset management, credit unions, and insurance firms across mainland China. Now, the research was conducted in conjunction with S&P Global, and we surveyed 3 distinct themes of awareness and optimism across 1, the changing regulatory environments, 2, attitudes towards ESG amongst investors and bankers in China, and 3, the outlook for M&A. And our panel today is here to further delve into some of these findings and provide insights into the recent regulatory and ESG policy initiatives in China and how they impact the business and investment climate and the challenges and opportunities presented to foreign firms. So no one's darling, and obviously to listen to me. So without further ado, I'd like to welcome our today's speakers, our industry of expert panels who are prepared to put their knowledge on the line to help us better understand some of these themes and perspectives we've highlighted in the research. So we have Mr. Cheng, the Director of the Center of International Collaborations at the Beijing Institute of Finance and Stability. Mr. Cheng is heavily involved with domestic and global green finance initiatives and has previously worked with the PBOC. Welcome, Cheng.
Thank you, Bradley. Thank you very much for inviting me.
Not at all. Welcome to the conversation. We also have Ms. Melody Yeung, a partner at Simmons & Simmons in Beijing, focusing on the fund industry, including private equity investments. Ms. Yeung advises global asset management groups on their China market entry strategies and the domestic firms on launching their overseas funds. Welcome, Melody.
Thanks, Brad. Good morning, everyone. Good to meet you online.
We have Raymond Yeung, Chief Economist for Greater China at ANZ, leading the China research teams based in Hong Kong and Shanghai. Raymond's work heavily focuses on macroeconomic analysis, monetary policy, and China's financial liberalization. Welcome, Raymond.
Thank you, Brad. Nice to talk to all the panelists here today.
And last but not least, we have Alicia Garcia Herrero, Chief Economist for Asia Pacific at Nexus CIB. Alicia covers monetary policy, financial and regulatory issues, including China trade and investment. She's also a senior fellow at the European think tank, Bruegel. Hopefully I pronounced that correct, Alicia, and also the Asia East Institute of National University of Singapore. Welcome, Alicia.
Thank you so much for the invite. Pleasure to be here.
So, just a few more things before we kick off the discussion, a little bit of housekeeping before we get started. Everyone dialing in, as you can see on your screen, I wanted to highlight that you can submit questions throughout the panel and we'll be trying to integrate and address them as we go along. Please also use the question mark button for any technical issues that arise during the session. And also note that we will be recording and circulating this webinar after the session. So, the big picture, the regulatory issues. To kick things off, I was hoping to turn originally to our economists on the panel to give us a bird's eye view of the major developments in China. So one of the big things the research indicated was a refocus towards common prosperity type products and services and an emphasis on digital transformation. I mean, Raymond, as a starting point, from your perspective, what are the key macroeconomic and developments impacting investor sentiments in the mainland today?
I think you've touched on a very important point, Brett. You mentioned about common prosperity. If you look at what has been doing by the leadership in the past few years, in Beijing. Basically, President Xi Jinping is trying to push for a wholesale change of the development model, shifting from a previously quantity-based model to a quality-based model. Want to not to focus on the GDP growth, and also definitely don't want the local official to aim for GDP growth as a performance target. They want to replace it with a broad range of scorecard indicated in the scorecard. For example, the KPI would include the CO2 emission and the energy reduction plan under the 14th five-year plan is to have the 13.5% reduction in the energy consumption over the next few years. We think that perhaps this will definitely be another regime shift. If we think about it, 40 years ago, China started to open up the economy. It's one whole period of economic miracle, simply based on importing or implanting foreign technology to the economy. Going forward, the next 15 years, the first phase of the new era, what we see is, I believe that the leadership is trying to use common prosperity as the major agenda in order to have a better redistribution of economic benefit to different segments of the economy. If you in the markets, in the financial market, we've been tracking the PMI, Purchasing Manager Index, every month on China, and persistently we saw that the small enterprise and the medium enterprise PMIs is underperforming, has been underperforming compared to large enterprises. So to some extent, this common prosperity include not only the redistribution of the benefit, but also a better access to opportunity by different size of the economic entities in the economy. From the ESG perspective, obviously the cost of doing business is also a major concern. And if the economy becoming more resource saving, and also China will rely less on the import resource, this is also one of the major agenda by the leadership at the moment. And I believe that under the current geopolitical situation, especially when you mentioned about foreign investor, what are they caring about? This is probably some of the talking points, some of the major themes that we really need to keep an eye on over the next few years.
So, I mean, Alicia, anything to add there? I mean, it seems Raymond's talked about obviously not just common prosperity, but also this shift towards less reliance on overseas and things like that.
Well, indeed, I think that's where we are. I fully agree with Raymond. I guess it's probably important for investors to understand what that means for them. I think one exception, which is important for this panel, is the financial sector. Probably Melody will talk more about it, that I think China is still very willing to attract investment. I would say for FDI is still the case that China is willing to attract. The point is whether China is willing to import as much from the rest of the world. That's where we see very stagnant imports from China for the last year, which means that as far as the rest of the world is concerned, that's what matters in terms of China's growth. So it's well below GDP numbers. But in a way, I mean, the question is, what else can investors do in China if that's the case? Yeah, if it's hard to export, is the opening of the financial sector something that investors should jump on? And I think this is where the demand comes. Investors aren't as willing as they used to. Whether it's portfolio investment, clearly there was a little bit of a positive mood on the equity side when things went really bad in the rest of the world, so February onwards. But they were back to meager growth of inflows into China, if not outflows, actually outright outflows for fixed asset, for fixed income, given the interest rate differential. But what is still an opportunity, and this is the topic of our conversation today, is of course ESG. Given the massive needs that China has ahead of itself, we just have to look at what's happening with hydropower. 20% actually of China's basket for electricity, so electricity generation is extremely important. That's where the money should be going, and that's where it's needed. So I guess I do share this gloomy growth picture and difficulties for foreign investors. But I think ESG is a very different ballgame. So that's all from my side.
I like that about, identifying where the money should be going and kind of the impacts of that. But Melody, I guess looking at these broader challenges raised by Alicia and Raymond, I mean, from a regulatory perspective, how is this impacting some of the regulations that have been rolled out? From your perspective also, are they achieving the goals that you expect? And how do you see potentially this impacting or being further refined in the near to midterm?
Thanks, Brad. So as a funds and regulatory lawyers, so certainly, we paid a lot of attention to the financial markets and the relevant regulations in the market. So in terms of the trends, from the regulatory perspective, basically we have seen two. The first theme is really the various enforcement actions that have been taken targeting certain companies in the relevant industries. And the second point is, second piece of trend is really, as Alicia has mentioned, the further opening up of the financial market. So coming back to the first point, ever since I believe summer of 2021, we have seen a lot of enforcement actions in the spaces such as cybersecurity, data privacy, as well as the competition law and anti-monopoly. So basically those enforcement actions, so they have applied in the aspects of a lot of time, for example, the data collection, usage, sharing, and transmission, and compliance of the antitrust competition law, and etc. So we believe, whilst we are very happy to report, as demonstrated by various signs, the enforcement actions are probably very coming to an end. On the other hand, those investigation areas I have just mentioned will continue to be the key areas that would be watched by the Chinese regulators. And of course, a lot of those companies, they used to be the most favorable targets of our fund clients, and a lot of those are in the industries such as the platform economy, tech, internet, online gaming, private tutoring companies, and etc. So through the series of the enforcement actions, so we have seen the following types of companies, they would probably attracted most of the attentions. So, for example, those mega platform companies, which may become too big to fail, and they have been very deeply intertwined with the financial system and economy. They have playing a dominant role in terms of the supply chain from upstream to downstream, and also those companies that may bring the national security or other kinds of security concern to the Chinese regulator. For example, the companies, so those who have owned an enormous amount of the data of their domestic customers or end users, as well as the companies that are within the very specific key and fundamental industry, also closely intertwined with the national interest and people's livelihood, such as the education and private tutoring industries. So the whole purpose of taking the enforcement action is, of course, to create a more vigorous, compliant, and healthy financial market and economy in the longer term. So in light of all of the enforcement action, so we have seen there has been certain turbulence caused to the capital market. So we have seen CSRC and other financial regulators. So they have also expressed their view and request that hopefully going forward, all of those enforcement actions taken by various regulatory bodies, so they would be and they shall be more aligned, and it's really the regulator's responsibility to really prepare the market, so rather than really giving them more surprises. So which is really a good sign to to be shared to the market. And apart from that, apart from all of the enforcement actions we have seen targeting those relevant industries, so we have also seen a further opening up of China's financial market. So as Alicia has mentioned, so China indeed has the needs to open up its financial market. It needs to attract the foreign capital. It needs to continue its structural reforms. So we have seen several themes which are also covered in the report published by Regulations Asia. So for example, just to pick up a few themes, the inclusion of ETF into the Stock Connect program, which makes the investors of both Hong Kong and mainland to get easier, make them gain easier access to the ETFs listed in the jurisdiction of the other side, and also the GBA Wealth Connect. So the GBA Wealth Connect launched in the Greater Bay Area, which allows the investor to purchase the low to medium risked products launched in the other host jurisdiction. So there are still investment quota and relevant qualifications, but the qualifications become much easier to be met. And this has really creates a new marketing routine for the funds of both ends. And the alignment of the standards of the two most important bond markets in China, CIBM and the exchanges, the potential inclusion of futures into QF, qualified foreign investor scheme, and also the issuance of China's new futures and derivatives law, which just became into effect in the beginning of August. So the new law has adopted the international standards of one single agreement and close-out netting, which is shown as a very important sign to bridge up the local standards as well as the international customs. So there are of course more to be looking forward to, but in a nutshell, so we have also been very pleased to see that the financial regulators, they have also been quite determined to continue open up the financial markets and make the routes much easier for the foreign investor to gain access to the Chinese market. So that's all from me in response to your question.
No, that's fine. There's a lot to unpack there, but I wanted to deep dive a little bit more in terms of the role of the foreign investor. I mean, one of the big changes I think that we've seen is really kind of this shift away from the growth above all. But obviously there are some regulatory developments that have been there for a while. You've mentioned the Greater Bay Area kind of initiatives. We've had the Wealth Connect pilot programs for a while. I mean, Raymond, from your perspective, are you seeing potentially a multi kind of growth China? And what is the significance of the opening of the Greater Bay Area cities?
Yeah, look, Brett, the big picture is that China's still committed to opening up, the economy. Some of the regulatory tension that we have seen, when Melody mentioned about the tech growth and also the private tutoring, is trying to induce the vibrancy of the industry and the marketplace in the domestic market. At the same time, for Greater Bay Area, this is really another level of opening up after Deng Xiaoping visited Shenzhen in 1992. And now this time, as Xi Jinping also visited Shenzhen a couple of years ago, and try to reiterate the idea that the Greater Bay Area and Shenzhen area is really important for Chinese long-term growth. And when they make a decision, the Beijing is making a decision for the next 5 or 10 years down the road, rather than next 5 or 10 months. And this is the different perspective compared with other countries. Look, this is an economy for Greater Bay Area, $1.7 trillion economy, bigger than many other countries. 86 million people are living there. And then we've seen in the past few months already some of the breakthrough in terms of the liberalization. When Alicia mentioned about foreign direct investment, in fact, it's a very clear policy direction for Guangdong province to push forward this Greater Bay Area liberalization. For example, just a couple of weeks ago, they mentioned about Nansha area allow Hong Kong people paying Hong Kong tax, Macau people paying Macau tax over there. So this is clearly a step forward to have a better integration between the offshore and the onshore market. Now, of course, giving them more time, I think that would start to bear fruit. And of course, currently it is very difficult to see the cross-border mobility because of the COVID situation. But given the situation, if the COVID situation gets relaxed, I believe that the cross-border mainland Hong Kong, in terms of people flow, capital flow, and also good flows, will be normalizing or even be better than the previous regime.
It's interesting that you mentioned the role of Guangdong with the 86 million people. I mean, I lived in Guangzhou, for example, for 20 years, and there's 21 million people in Guangzhou. And essentially, Guangdong is often seen as the factory of the world. I kind of just wanted to maybe deep dive a little bit more on the ESG side. I mean, the focus on ESG and green credentials is nothing new. It's something we have been looking at for a long time, as we've been wrestling with the environmental fallout of, the industrialization that we've had over the past 2-3 decades. But in the research, 94% of respondents considered that climate risk and data was part of their institution's business strategy, with 54% indicating an impact on decision-making processes today on pricing, credits, and loans. I mean, Chen, I wanted to get your thoughts on, one, does this surprise you? And how do you see ESG conversations materially impacting the focus on decisions being made today in the mainland?
Thank you very much. Yes, that's a very good question, actually. In terms of ESG, there are 3 pillars: environment, social, and governance. And mostly, I think in many financial firms and maybe corporations as well in China, I think they're focusing still on the environmental pillar, so on E. And more specifically, they were focusing on environment, now more gradually switching to climate. So I think on environment and climate, the firms, the financial firms, and also corporations, especially those public ones, are focusing more and more on the environment and also financial disclosure. So back to your question on how they are making decisions when they are making either investment or making a project investment or something like that. I think the priority has been shifting from in the past purely or mostly on returns to now focusing on both returns and also environmental benefits, of course, for 2 reasons. The first reason is the investors' appetite, and many of the investors are asking banks, especially listed ones, to engage and demonstrate their, let's say, preference and also performance in the ESG pillars, especially on environment. And the second driving force is coming from regulation, especially since 2016, when the green financial market in China has been growing and established since then. And especially, I think after 2020, when China announced the pressure, I think it's getting higher and higher for relevant financial firms and enterprises. So the green finance market is a very good demonstration of how the decision-making process has been growing so fast in to consider or embed ESG elements. Just give you a few numbers. So by end of last year, the green loans market in China recorded more than $16 trillion or more than $2.5 trillion. So 16 trillion RMB and more than $2.5 trillion already, and a growth rate of more than 33% compared to last year, while the aggregate growth rate for all loans, so that means are growing 3 times higher than the non-green ones. And the green bonds market sees actually even larger growth rate. Last year, the green bonds, newly issued green bonds recorded more than 600 billion RMB or $100 billion US dollars, close to $100 billion US dollars, and a growth at a rate of 1.8 times. So that means the financial firms and also investors are paying more and more attention when they are making the investment decision-making process. And the other side, as I said, is driving from the regulators, from both the central bank and also the banking regulator. I think they are all coming up with quite a few measures to support and also regulate. The most, let's say, recent case is the carbon reduction facility released by the central bank, PBOC, with a very low interest rate, 1.75%, to support 3 specific sectors, including renewable energy, co-benefits for the environmental pollution, and also carbon reduction, as well as CCUS facilities. And the other side is enhancing, let's say, environmental disclosure as required by the regulators from both the PBOC, central bank, and also banking regulator, as well as the CSRC. And as we see more efforts being made to align the disclosure requirements domestically and international practices, especially by considering the TCFD framework and also the ISSB, which is under discussion. I think the signal is very positive that the government and also the governor of PBOC is very clear that the disclosure requirement for the big firms, especially financial firms, will be gradually moving to mandatory in the future.
I wanted to just quickly deep dive on the ESG disclosure component. I mean, yet again, in preparation for today's discussion, I noticed there had been some criticism, I guess, around disclosures. And when we go back to the research, 65% of the respondents actually rated the quality of corporate ESG disclosures as closer to very poor versus excellent. So, I mean, Chen, from your perspective, one, do you agree? And I guess more importantly, how do you see the approach being taken in China differing from the EU or other countries?
Yeah, so in terms of disclosure, I do tend to agree that actually the quality and also number of disclosures is still not very good, at least from my perspective. For one, disclosures by listed firms and also maybe the public, other public or bond issuers, they need to improve for quite a few reasons. So one thing is they lack the capacity needed to come up with something, the most needed information by the regulator and also investor. For example, in terms of carbon emission, absolute and also carbon intensity issue and numbers, they face quite a lot of challenges, including the big ones and also smaller ones. So they have been working very hard on carbon accounting and pilot projects in the China, I think 8 or 9 provinces and also more than 10 cities are still working very hard on it. And the second thing is the first thing is the number of the disclosure. Second thing is on quality. The quality issue is more like comparability and also the depth of disclosure. And maybe from different perspectives of different investors, they probably are looking for different numbers. For example, I want to see how much carbon you saved in your balance sheet, but actually this number is broadly not available for many financial firms and also preparers of these reports. And on the other hand, they are also trying to figure out which framework to follow. Well, in China, there is a broad, let's say, a concept of framework. For example, the one released by PBOC is called the Guidelines for Financial Firms to Disclose Environmental Information, which is largely aligned with TCFD. But actually, there are still a lot of spaces where each financial firm and preparer of the reports can maneuver based on their own situation. For example, in terms of, let's say, governance, to what extent and to what granularity do you think the disclosure will be, let's say, agreeable and welcomed by the market will be something more like a question. So from this perspective, I think the regulators in China, including the PBOC, CBRIC, and also maybe the Ministry of Finance, are also trying to see how the disclosure frameworks can be more, let's say, developed and also improved to be connected with the international ones. For example, the ISSB's disclosure framework, which is just finished the public consultation process, I think was expected to be formally released before end of this year. So that with that in mind, I think if the SSB framework can be used as a global baseline for disclosure and can be used in China as well, I guess, which is very likely that at least some of the elements or maybe most of the ISSB standards can be welcomed and also used by some firms in China. That will be more helpful in alleviating some of the challenges or criticisms by the investors in the market, including the number of disclosures will be improved and also the quality of disclosure will be improved.
Alicia, just kind of following on from that, when we look from outwards inwards, do you see the actions being taken around ESG by international, by domestic kind of institutions and corporations, when considering the perspectives of international investors, is it seen as real progress by international markets?
I think there's a disconnect, which is the following. As regards green finance and, level of issuance of green bonds in China, all of that looks really good domestically, and I'm sure that it looks appealing internationally. The issue is whether that really reflects progress in what green finance is about, basically financing transition to sustainable development and especially sustainable climate change, whether it's climate mitigation or reducing emissions, you name it. I think that's where the disconnect lies, and the reason is that it's not so much about China's path towards commitments. The commitments are there, 2030, 2060. I mean, that I think those commitments are, in a way, long-term commitments, and China seems to be taking, the actions needed. But the investors increasingly look at, things like share of coal in electricity production. I mean, basically the stock, if you see what I mean, the stock rather than the targets. And I think that's where the disconnect lies, that investors can't figure how is this happening. They see, say, China, producing 80% of solar panels in the world, but still renewables is a small share. It is increasing, but they just don't see the stock rather than the flow. And I think that is somehow what, to me, especially if you think about sovereign wealth funds or like more purely institutional investors, it's harder to accommodate. So that's a disconnect. Domestically, I think it's well understood and the market is booming, but international, I think more signals of that shift in the sources of energy should come. And I think China is heading there, but possibly with a lot of uncertainties. So one is, of course, nuclear, that big transition for some, not for others, at least for Europe already there. But basically, how are you going to get there? I think that further push will be needed from China's side, for foreign investors to believe that massive China story of ESG beyond the size of green finance in China.
So it's interesting. I mean, 94% of the respondents we spoke to actually mentioned that climate risk and data is part of their institution's business strategy. So Alicia, if this is the case, what do you see as critical drivers for change moving forwards? Where are the opportunities, challenges, bottlenecks?
Well, I think there's a huge reinsurance market in China on this front. I think there's going to be a revolution in the insurance market in China to dwell further on what concerns climate change mitigation. This is already very visible in Europe, and I think China is clearly a major growth market for that. So if you think about very well-known and surely valuable JVs between European insurers and Chinese insurers, whether it's insurance or reinsurance, I think there's a lot there to kind of think about in terms of that progress that you mentioned. So that's the insurance part of the story. Beyond that, I guess, we've already talked about that, taxonomies, thinking of joint taxonomies, or Europe and China have already gone through that, but I think much more is needed, reducing the greenwashing part of it. I mean, kind of making it clear that this is an international endeavor, both in terms of standards and objectives. And I think the objectives are there, COP26, but the standards aren't yet there. So these are my two highlights: insurance, reinsurance, and standards, harmonized standards for this purpose.
I mean, Cheng, just to maybe drill down on that kind of number a little bit, 94% of respondents are considering climate risk as part of their business strategy. I mean, does that kind of ring true with you? Is this aligned with your expectations? Because it essentially sounds like everyone's actually considering climate risk at this point in time. Based on your experience, is that a reality?
So my understanding is that based on that, probably will be different based on which part of the financial firm or which part of the, let's say, respondents you are investigating. If it is big and the larger ones, I think they will be more aware of the climate risks. But smaller ones, they probably are still on the way to build up the capacity and also awareness on climate risks, especially on regulatory or the transitional risks for them. So I guess if you are doing the investigation, among the big ones, I think 94% of them could be real. But if it is smaller ones, I guess that will be less likely.
No, that makes sense. I mean, yet again, given the number of financial institutions in China, there is a massive gap between the big and the small, right? Is this itself going to potentially create some longer term issues?
I think that will be, let's say, not longer issue, but actually, since if we can tell the story about the carbon neutrality, let's say 2 years ago when the carbon neutrality goal was raised in China, almost nobody knows how that would affect their business and what that means. And now I think everyone is talking about the carbon neutrality, although they still do not really know how climate risk is let's say, affecting their business or profits and through which channels. But they do understand that there is a risk, especially from the regulatory perspective, so they know it. But from, let's say, a great difference between or among the financial firms in China, I guess the difference would be gradually bridged as we go. And if you ask them again, maybe 2 years ago about climate risk, I think the number will be more likely to be around like 90% of the respondents. I would also, so Bradley, if possible, I would also like to maybe respond to what Alicia just mentioned about the few perspectives where the sovereign, maybe wealth management firms are talking about, especially when they talk about the disconnect between green finance and green financial market is very big. Well, I think there's still some perspective, or at least a perceived risks on how that would be looking like. I think that might be making sense that they think the greenwashing risk is still very high, given that the crude stock is very huge and China is contributing like 1/3 of the global emissions. So whatever the green finance market will be looking like in real numbers is, you still think maybe you're still relying very heavily on coal and also emitting too much. So whatever the number would be, I think the risk would be high. So that could be more like a perceived situation. And I also was thinking maybe that can be, let's say, partially solved if we look at the technical side. For example, to address the issue of standards raised by Alicia, actually China's regulator and also the market has been working very closely with the international platforms, including the EU counterparties through the IPSF platform. And they just developed a common ground taxonomy, which is a standard used to develop green bonds and also to label green loans. And the practice is finished in June this year and updated with the common ground taxonomy between China and the EU, and found actually a lot of overlaps between the standards. So standards are there, and doesn't mean that investors are not recognizing the similarities and also differences, which are, if we, let's say, label the flow of funds according to the common ground taxonomies, actually the similarities will be even higher. Because among the more than 200, let's say, categories of industries, which is very specified in each big category, not all of them are receiving equal amounts or ratio of funds. Most of them are going to renewable energy, green building, transportation, and maybe some co-benefits between environmental and also climate risks and climate change, as you mentioned, mitigation and adaptation. So if we count or label the fund flow based on the CGT or common ground taxonomy, I think the similarities will be even higher. But since China is a major emitter and contributing to 1/3 of the global emissions, people still would have the perception that China green finance market is always big, and comparing to its share of the global emission, actually the risk of greenwashing is still very high. But from our perspective, especially technically, I think that will be less an issue, especially for greenwashing, if we see case by case and also on technical standards. I think that will be less a challenge from the investor's perspective.
Wonderful. I was going to say, just, I mean, yet again, still considering the ESG, but I wanted to shift to M&A and investment a little bit. And Melody, to get your thoughts. I mean, given the regulatory landscape, the increasing focus on ESG, the potential for even greenwashing around, you know, investments in around the environment conditions for M&A activity. I mean, what are you seeing around this space?
Right. Thank you, Brad. So in terms of the trends in the M&A space, interestingly, I think in the past year, in the year 2021, China actually saw really reportedly a record high M&A activities. However, when we are currently in the year 2022, the M&A activities become comparatively much quieter. So understandably, so there are many reasons. The pandemic situation in the domestic, certain domestic cities, the geopolitical tension, and also the turbulence caused to China's stock market, which has made the exit of the the funds even more difficult. So in terms of the trend, we have seen, given all of the enforcement actions we have discussed, so we have seen definitely there has been a shift from, for example, the software and the platform economies to those hard tech or deep tech industry, the consumer, healthcare, biotech. So a lot of the focuses are really on the, in a way, upgrading of the manufacturing, upgrading of the consumer industry, restructuring, supply chain reconfiguration, and etc. And when we come to the financial industry itself, so interestingly, we have also seen and more buyout. So some buyouts are happening really between the firms. Some buyouts are really happening between the teams. So that is because China has also putting its efforts to reform its financial industry. So for example, compared to several years ago, currently a lot of emphasis on the financial firms' own internal the hardcore asset management capabilities. So a lot of the financial firms, such as banks and trust companies, so they are known as having the wide range of distribution. They are known of having the vast base of investors, but they are comparatively less well known of their own asset management capabilities. And all the banks probably in the past, they focus more on the bonds investment rather than equities. So now we have witnessed a number of buyouts really between the teams. So for example, when the bank is establishing their own wealth management subsidiary, they really need to buy out a team from other type of financial institutions and private fund managers to really strengthen their portfolio management teams. And also another trend we have seen is really the foreign shareholder. They've started to buy out more stakes to increase their shareholding in the financial institution, along with the reflection in the foreign shareholding limits in basically all types of the financial institutions. So that's all from my side.
One of the questions from the audience actually was around greenwashing. And, you had talked about enforcement actions. I kind of really wanted to understand, how robust is the greenwashing regime in place at the moment? And have there been any enforcement actions around greenwashing?
So I can share briefly on this. So I believe Lin is really the expert in this space. So in my view, a lot of the ESG regulations, so they are still evolving. So there hasn't been a lot of the mandatory disclosure requirements there yet. So not to mention the requirements against the greenwashing. So for example, in the ESG space, apart from PBOC, the banking regulator, we have also seen CSRC and AMAC, the private fund regulator. They are in the process of issuing their own green investment guidance. So following really SFDR and other disclosure requirements. And our firm has also been involved in the process a little bit. So I think one key discussion taking place is really that so what kind of route to follow? So for example, whether the regulators are there to actually label those green funds according to certain standards. So as I understand, for example, I think the UK and the US, they are in the process of legislating their own ESG disclosure requirements for funds. So probably they are more leaning towards the sort of the labeling rules, or whether for China's funds regulator to follow the EU standards to compare to labeling the green fund to ask for better transparency. So like a lot of those issues like labeling or better transparency, a lot of the issues are really still in the air and really left unresolved. So I wonder whether Lin has anything further to contribute on the point of greenwashing.
Thanks, Melody. Bradley, can I come in directly?
Of course, go for it, please.
Yeah, great. Thank you very much, Melody, for the introduction on that greenwashing issue. Actually, to combat greenwashing, I think there are two things at least to do. One thing, of course, is to enhance the standards, and second thing is to enhance disclosure. On standards, I think I already mentioned about the standard for green loans and green bonds, which is public. For green loans, it's OTC market, but it's also very much tightened, and also regulator will have a chance to just review the loans book on the banks. And for ESG investors, especially for the, let's say, funds and also equities, I think that's a much challenging issue. For one thing, is ESG methodology is so much proliferated in the market. Almost everyone can develop its own ESG methodology based on its own weighting and selection process and methodology. So that means it is more like a market-based issue, and you probably need to enhance the ESG regulation from point of view, either enhance its disclosure. For example, if you develop your own ESG methodology and use this methodology to label your own assets or portfolio, you have to disclose the methodology as well. For example, how much ratio of the E has been considered and which indicators are used, and also for S and for G, and how you will track the performance of each of the portfolio assets against the ESG performance or the indicators. And on the other hand, of course, we see recent, let's say, incidents or cases in Europe and also in the US as well. Some asset managers are more likely using the ESG development methodology on their own and also label their assets. So that let's say, push the urgency for regulating ESG investments or ESG methodologies to a new high. And this leads to more like a disclosure requirements under the SSB. Before it was formed, there was kind of gradual consensus among the regulators saying we need to make the ESG information also auditable, comparing to, let's say, the conventional financial audits. They want to make the ESG information auditable. That means the comparability among different ESG methodologies needs to be enhanced. But how to do that, I think, might also need to be coordinated among the regulators and among different jurisdictions. Within the G20, we also heard that there was a kind of push to make the ESG developers more likely aligned and also make them more transparent. But there was also some kind of pushback saying this is market-led, and we should give them more opportunity and space to develop and compete. While in the meantime, how to enhance the comparability of ESG methodologies is still an issue. And we would like to share the concern that actually for the ESG market, how that can be done. And if we want to use the methodologies or the approaches to combat greenwashing issues and concerns in loans and the green bond market, so enhance the standards and also enhance disclosure is still used, can be used to enhance the credibility of the ESG market.
I definitely think your concerns are heard loud and clear there. I mean, I just would like to move, in the last 10 minutes that we have here to focus a little bit more on the M&A and investment perspective. I mean, Alicia, let's just consider the outbound deals, investments by domestic firms. We definitely saw a significant decrease in the number of deals and the values comparing 2020 to 2021. Potentially, this is a big shift inwards driven by a whole lot of different issues, whether that's, something to do with the COVID, regulatory changes, or maybe shifting priorities around the world. From your perspective, is this what you're seeing? But more importantly, is this kind of shift inwards something you expect to stay in the medium to long term?
Yes, thanks so much. I was trying to chip in on the taxonomy, but you're right. I think we have enough, and only if time allows, I'll make that comment. So on your question, M&A, we just issued a report basically looking at M&A into Asia. And the whole idea is that not only China, which is clearly decreasing, both outbound but also inbound, this is true for the rest of Asia too. It's just that not as much as for China. So, I think COVID has had a toll on M&A globally. I think we see that. We want to focus on China here, but I think it's important to realize that this is a global phenomenon. And partially because China is also not investing overseas, but it's not only about China. Now, there is some reshuffling into Australia. Australia is a good big winner, especially from US, Europe. And we also see ASEAN, this is in relative terms, again, overall, except Australia, everybody's coming down. ASEAN and India are increasing their share of a smaller pie, though. So I think this is important because it shows that, yes, we talk about ESG, which is a global phenomenon. We try, going back to the taxonomists, to find common ground, to find, synergies, to find standards. But it is very balkanized, it's very fragmented. And this, in a way, is reflected in this lack of appetite, generally, M&A coming down, because the world is less global. And I think those numbers are showing this. So the question is, how can we solve such a global problem with a less global world? And I think that's what I want to highlight here. So indeed, the M&A figures, not in 2020, China actually increased, received much more M&A than in the past. Also greenfield investment, but 2022 is a different story. It's kind of after, the respite of first in, first out for COVID, we're seeing that the world goes back to where are we heading? And that's the negative about these figures throughout Asia, as I said.
Excellent. I mean, so yet again, Raymond, I mean, what are your thoughts? Do you expect this inward turn to last? I mean, 2022 is different. As we look to 2023, what do you expect?
I look at the not only outward investment, but also the inward FDI to China as well. That last week was a number of 17% increase in FDI compared with last year in terms of the utilization of capital. But if you look at the contractual amount, that's actually been dropping to 13% drop nationally in terms of FDI. I think foreign investors becoming more selective and target in terms of how they see China. But it doesn't mean that there is no opportunity for M&A, whatever. We know that of all these FDI, 75% of them actually come from Hong Kong. When China can the FDI, then Hong Kong is part of their foreign entities. And that's obviously involved a lot of M&A transaction flow to China. And sort of big ticket item that they name by the Ministry of Commerce is, for example, EV. Germany car maker continue to see China a big market, especially when China expect that half of the auto market will be EV by 2035. That's a big number. It's a massive boom now currently with battery industry and also EV industry. I think this is a real deal. And even though a lot of course, foreign investors currently, because of the geopolitical tension, because of different various consideration, including the Semiconductor Act in the US, may probably affect some of the sectors. But so the less sensitive sector, China continues to be the magnet. I mentioned about the GBA, and Guangdong has already seen a massive increase of new emerging industry or high-tech industry FDI actually rose by half, in the first quarter. So that's some of the number that I can cite. But at the same time, of course, that what I see anecdotally from speaking to clients, speaking to lots of different corporates, obviously 2022, because of Ukraine, because of different developments, then they are becoming more selective. And Alicia mentioned about not only China, but also Asia as well. I think it's a big opportunity. Whenever we see this relocation of or realignment of the global supply chain, of the China supply chain towards ASEAN, towards India, Vietnam, and different places, in Asia, then we see a very different landscape, and the dynamics of M&A dynamics will be very different, over the next few years.
So you mentioned Hong Kong's role in a lot of these flows, but we've also mentioned the significance of the Greater Bay initiatives. So Raymond, I mean, from your perspective, what will be the impact of the Greater Bay in terms of inbound, outbound investment flows? And will this essentially just nullify some of the flows that we've already seen from Hong Kong?
Yeah, I see if the assumption or the basic assumption is a closer economic relationship or a better integration between across the Shenzhen River, then Hong Kong started to develop the northern district and wanted to develop the metropolitan area closer to Shenzhen. At the same time, Shenzhen, I believe that we will have having a lot more flow and take opportunity of this Hong Kong development. look, we are living Hong Kong in the offshore markets, it's having a very different jurisdiction, and under the basic law, there's no capital control. Xi Jinping himself, when he visited Hong Kong, I think it's the first time I've heard about that he himself talked about that Hong Kong has to maintain the common law system. It's out of the blue. When he mentioned that it's under the current political situation, he talked about something that surprised the audience and reiterated the role that Hong Kong's continued to be the gateway in the past, for foreign companies to go in China, but Hong Kong actually is also a gateway for Chinese companies to go out. So how to, can the cross-border flow can facilitate a better integration? I think that would be this year because of COVID, but after COVID, I think that we will see a lot more transactions and a lot more, deals that will be happening maybe 2 or 3 years down the road.
Understand. And with that, unfortunately, we're out of time. We haven't been able to answer every question in its fullest details. We've only obviously just started to scratch the surface today. Still, we welcome the listeners to email us and visit regulationasia.com to learn more about the work underway across the region to research and address a lot of these emerging issues in China. With that, I wanted to thank our panelists for their insightful discussion. Chen Lin, Director of the Center of International Collaborations at the Beijing Institute of Finance and Sustainability, Melody Yeung, partner at Simmons & Simmons in Beijing, Raymond Yeung, Chief Economist for Greater China at ANZ Bank, and Alicia Garcia, Herrero, a Chief Economist for Asia Pacific at Nexus CIB. And of course, thank you to everyone for joining the discussion today. We look forward to speaking with you all again very soon. Thank you and goodbye.